On June 3rd, the Japanese yen broke above 160 to the dollar. A month after that, Japan spent billions of dollars defending it. Underneath that number sits $97 trillion of US dollar debt hiding inside foreign currency swaps. The Bank for International Settlements calls it missing debt. Here's the plumbing of this entire process and why it lands on your retirement accounts first.
On May 22nd of this year, with almost nobody paying attention, a man named Kevin Warsh was sworn in as chairman of the Federal Reserve. The Senate confirmed him 54 to 45, the closest vote in the history of that job. And the president who picked him has said out loud more than once that he wants interest rates cut. I know that sounds like inside baseball, the kind of thing you scroll right past. Stay with me for 2 minutes because it is about to become the most important thing happening to your money. And here is why. There is a fire building in the world's currency markets. It is enormous, it is almost completely hidden, and the Federal Reserve has personally put out a version of it twice in the last 20 years. On June 3rd, the first embers landed in Tokyo when the Japanese yen broke 160 to the dollar. 1 month after Japan spent about $73 billion trying to stop exactly that. It did not work. So in the next few minutes, I am going to show you how big this fire really is, why the only extinguisher that fits it is the American Central Bank, and why a quiet change at the top of that bank in May might be the most dangerous detail in the entire story. Let me start with a number you have probably heard because a lot of finance videos are throwing it around. They call this a $100 trillion crisis. That number is wrong, and the real one is worse. An institution in Basel, Switzerland called the Bank for International Settlements, the central bank for central banks, actually audited this. The honest figure is $97 trillion. And the part that should raise the hair on your arms is that 80 trillion of it does not appear on a single balance sheet anywhere on Earth. Someone rounded up for a thumbnail. The auditors rounded down and told you where the bodies are buried. So what is this 80 trillion? And how does a currency fire on the other side of the planet reach your house? Here's the plain version. The whole world runs on dollars it does not actually own. Almost 90% of every currency trade on Earth has the dollar on one side of it. About half of all world trade is priced in dollars, even though America is only about 1/10 of that trade. So if you are a bank in Tokyo or a company in Frankfurt, you are constantly borrowing dollars you do not have. And the way you borrow them is a thing called an FX swap. Do not let the name scare you. It is a pawn shop for currencies. You hand over your yen today, you get dollars, and you sign a promise to swap them back in about 90 days. That promise is the debt. And because accountants treat it as a future promise instead of a loan, it never shows up as debt. That is how $80 trillion goes missing in plain sight, larger than all the short-term US government IOUs, all the overnight lending, and all the corporate paper in the world combined. And every 90 days, it has to be paid back or renewed. Now, the calm voices will tell you not to worry, and they are not entirely wrong. So let me give you their case honestly. Most of this is just hedging. A pension fund, an exporter, they use these swaps to protect themselves, and in normal weather, it all nets out quietly in the background. Traders even pushed back publicly when the BIS raised the alarm. All of that is true, right up until the moment dollars get expensive, because a promise you have to renew every 90 days is only as safe as your ability to find dollars on renewal day. Take that away, and the whole thing turns. We have watched it turn before. Just over 29 years ago this week, on July 2nd, 1997, Thailand ran out of the dollars it needed to hold up its currency. It gave up and let the currency float. And within 18 months, a thing people had called the Asian miracle had become the Asian contagion. The Korean won lost half its value. The Indonesian rupiah lost 80%. The government of Indonesia fell. The IMF wrote the biggest emergency checks in its history to that point, $58 billion for Korea alone. And here's the thing I need you to sit with. 1997 was the easy version. Back then, the hidden dollar debt was maybe 1 or 2 trillion, and it sat in a handful of small economies, and the IMF could physically wrap its arms around it. Today, it is 80 trillion, spread across every major financial center in the world, and the center of the current fire is Japan. Not a small emerging economy, the largest creditor nation on the planet. There is no rescue fund big enough for that. There is only one thing big enough, and it is the machine that prints the dollars everyone owes.
Hey, sorry to jump in, but if you would like to learn about Bitcoin, XRP, any kind of crypto, how to invest in it securely and safely, I put together the Bitcoin and Security Bundle, 2 courses that covers what's actually preserving your purchasing power during a debasement cycle, and how to properly buy it, store it, trade it, sell it, make money from it, and not get screwed by it. All right. With that being said, take a look at the link below. Now let's get right back to the video.
So how does that machine actually work step by step? It starts with a shock. This spring, the scare over the Strait of Hormuz sent oil toward $120 a barrel. The Fed signaled it might raise rates instead of cutting them, and money did what it always does when it gets nervous. It ran to the dollar. Now watch the trap close. When the dollar rises, every one of those $80 trillion in IOUs suddenly costs more to pay back. So everyone who owes dollars scrambles to get dollars all at once at any price. And that scramble pushes the dollar even higher, which makes them even more desperate. That is the piece almost nobody explains. A currency crisis does not have to look like the dollar collapsing. It can look like the dollar going straight up while the rest of the world drowns trying to buy it. And when a country tries to fight back, watch what it has to sell. To defend the yen, Japan needs dollars, and Japan holds about $1 trillion of one particular asset, U.S. Treasury bonds. So it sells them. That is not a theory. In March of 2020, foreign governments pulled $147 billion out of their U.S. Treasury holdings in a single month. And the 10-year Treasury bond, the one your 30-year mortgage rate is priced directly off of, did not behave like a safe haven. It spiked from about 1/3 to over 1.25% in 9 trading days while the stock market was crashing. Read that again. Your mortgage rate can go up in the middle of a global panic precisely because everyone is selling the bonds that set it. A strong dollar also quietly eats the roughly 40% of big American company revenue that comes from overseas, and that shows up in your 401k. The fire does not stay in Tokyo. It runs down a pipe that ends at your mortgage payment, your retirement account, and the price on the gas pump, which brings us to the only institution that can put it out. And the reason I started with a swearing-in ceremony. When this fire jumps, the Federal Reserve faces exactly 2 doors. Door 1, it prints dollars and lends them to the rest of the world, the way it did to the tune of $583 billion in 2008 and $449 billion in 2020. That door is the inflation bill, and you pay it at the store. Door 2, it refuses and lets the defaults on that 80 trillion come home through the banks and through world trade that simply stops. That door is the recession bill, and you pay it with your job. There is no third door. And one more thing the comforting version leaves out. Those emergency dollar lifelines only exist as standing arrangements for 5 central banks. The other roughly 150 countries are already on their own. For 20 years, the entire system has rested on one quiet assumption, that the Fed will always run to door 1 without hesitating. It did in 2008. It did in 2020. But that assumption depended on a Fed that saw itself as the world's lender of last resort and acted like it, fast. And that is the detail that changed in May. The person who now makes that call is not Jerome Powell. It is Kevin Warsh, 7 weeks into the job, confirmed by the narrowest margin in the history of the position, installed by a president openly demanding cheaper money over loud warnings about the central bank's independence. I am not here to tell you what kind of chairman he will be. I do not know. But I will tell you this. Foreign central bankers are already asking on the record whether this Fed will open the dollar spigot in a crisis as fast as the last one did. The debt was always the fuel. The Fed's reflex was always the safety. That reflex is now an open question. And here is why I am telling you specifically. Every single version of how this plays out ends the same way, with your money waiting on somebody else's decision. A swap line that may or may not open, an emergency facility, or capital controls like the ones Malaysia slammed shut overnight in 1998, trapping money inside the country before anyone could move it. The whole reason a person holds an asset with no counterparty and no 90-day renewal date is so that they own one thing that is not standing in line for a rescue. One thing that does not need a committee to vote before it works. So let me leave you with two versions of the next 12 months. In the first one, the embers in Tokyo stay embers. The Fed's hand proves steady, the hose comes out right on schedule, and a year from now, you have forgotten you ever watched this. In the second one, the fire jumps from Tokyo to Seoul to the swap market, and a 7-week-old chairmanship hesitates for just 3 days. And by the time the dollars finally flow, the 10-year Treasury has already done to your mortgage what it did in 9 days in March of 2020. You do not get to choose which of those you wake up in, but you do get to decide right now, today, whether every dollar you own is standing in that line for a rescue you no longer control. Watch 3 numbers and you will know which version you are living in long before the anchors say a word. Japan's monthly currency intervention reports, the Fed's weekly swap line usage, and the monthly Treasury holdings data. The debt was never the surprise. The hand on the hose is. Economic Ninja is out.